Dear investors, in this monthly outlook, let us discuss the following topics. 1. Policy direction. We think growth focus continues. 2. Quarter 1 result season, which we believe has gone a tad better than expected. Third, continue to believe it is time for alpha, and we will see how the result season was for our key themes. Fourth, trend in institutional flows, FPIs, DIIs, insurance, till 19th of August. And ultimately valuation and outlook, where we believe we could see a period of consolidation. On the first topic, policy direction, which we believe continues to focus on growth and make in India. What we saw was RBI chose to keep rates unchanged in its policy review in August. We maintain that if forex reserves continue to be stable, RBI would have a higher degree of monetary independence, and given our focus on growth to be able to provide employment to our people, and in the event of stability on the external front, we expect RBI to continue to hold rates despite the last inflation print being unfavorable. We got a CPI of 7.4, not on account of core, but on account of food kind of stuff. While policy rates were unchanged, yields moved up in the US and in India, and we will note the impact it makes on valuations. GOI is continuing to focus on Make in India. We saw items like laptops being put under import licensing requirements, a clear indication that domestic manufacturing is preferred if one has to access the Indian market. Now, continued policy support is good for the morale of India Inc. and it helps. Coming down to quarter 1 result season, we believe it's a tad better than expected. After a 23% earning CAGR over financial 20 to 23, Nifty earnings grew 32% in quarter 1 financial 24. A beat versus our expectations of just about 25%. Coverage universe actually recorded the highest earnings growth in the last 8 quarters at close to 52%, fueled by domestic cyclicals such as BFSI and autos. Healthcare, after a long while, delivered 24% earnings growth, beating expectations. Aggregate earnings of the universe companies were more or less in line with estimates at 52 versus estimates of 49% YOY growth. Nifty posted a small beat with an EBITDA PAT growth of 22 and 32% YOY versus expectations of 18 and 25%. Once again, the earnings growth was propelled by domestic cyclicals such as BFSI and auto. BFSI coverage universe recorded a 60% YOY growth, while autos posted a significant profit of close to 18,000 crores, a large jump over a profit of just about 100,300 crores in quarter 1 of financial 23. Even excluding a large company, the auto universe registered a healthy 83% earnings growth in quarter 1 financial 24 versus expectations of 59%. Oil marketing companies' profitability surged to over 30,000 crores in quarter 1 financial 24 versus a loss of 18,500 crores in the same period last year due to strong marketing margins. Ex-OMCs, the Nifty earnings rose 19% versus expectations of 12%. Metals were a drag with a 40% YOY decline in earnings, led by practically all companies in the space. If we speak sectors, of the 22 sectors under coverage, 8 sectors reported profits above expectations, 8 reported in line, and 6 reported slightly under. Of the 235 companies under coverage, the 88 exceeded estimates, 87 missed estimates a bit, and 60 were in line. So it was more or less a very even quarter in terms of misses and beats. Going forward, the universe is likely to deliver sales, EBITDA, PAT growth of 7%, 22%, and 33% YOY in financial 24. This continues to be a year where margin increase would drive growth, and autos, oil and gas, banks are expected to be the key growth drivers with 77, 56, and 30% YOY earnings growth. Banks may have seen, by the way, their best quarter. Going forward, the growth could fall. These spaces will deliver over 70% of delta in earnings in financial 24 over financial 23. After the quarterly results, Nifty earnings continue to be in the range of 1050 to 1100 for financial 25. While metals were a drag in financial 24 and oil and refining pulled up the estimate, the opposite could be true in financial 25. Given that the two commodity spaces are cancelling each other's impact, the discounting range of 18.5 time earnings for Nifty should hold, and we continue to target 20,000 levels or thereabouts on the Nifty as our year-end target. Coming down to the next topic, that for Alpha, let's see how the result season went for our key themes. Retail-focused banks had a good season, and banks like ICICI, Axis, IndusInd, IDFC, and AU saw strong AUM increase, which we believe is the key monitorable as we go forward, and profit, the base of the profit has normalized. As expected, banks with significant corporate exposure saw a slowdown in AUM growth, and hence our focus continues to be on predominantly retail-oriented banks. Engineering and defense companies had a strong result season and reported good order inflows. Cable companies delivered better than expected results. Healthcare space as a whole, we had noted earlier as well, had a good quarter. Our focus areas of hospitals generally performed better than expectations. In China plus one theme, the EMS companies did very well. Chemical companies had a weak quarter on account of Chinese slowdown and inventory normalizations. However, chemical prices do seem to be, recovering after the quarter, and the outlook has improved. Luxury consumption as a space did very well. Hotels, malls, luxury retail, etc. all saw continued strength. This was in contrast to the wider space where volume growth disappointed and the bump in profits was mostly on account of margin increase. Our choices in the new tech companies, delivered strong numbers with a sharp reduction in EBITDA losses. That definitely helped sentiment in this space. In the tech services space, mid-cap tech companies, generally speaking, performed better than industry leaders, especially companies where their focus areas were experiencing some amount of tailwinds. Overall, the result season was strong for us. We had lower exposure to pharma, which did well, but made it up by being exposed more to the other performing spaces. Key driver of performance is earnings growth. In the quarter also, the broad market delivered better earnings growth versus Nifty in a meaningful manner. 52% for the broader market versus Nifty at 32%. Indicating that it continues to be time for alpha. Next topic, trends in institutional flows. Buying continues in August. India remained the most sought after destination for FPIs for the fifth month in a row in July 23 with equity inflows of USD 5.7 billion. The inflows have been on account of some money moving away from, let's say, Taiwan, which saw selling of 3 billion, and inflows into India dedicated passives of 1.4 billion and active funds of 0.9 billion. Increasingly, India funds are seeing inflows, while today active funds make up just 2% and passive 4% of FI AUM respectively, and this we hope continues into the future. Non-India dedicated active funds, 77% of FPI AUM comes from there, bought 2.5 billion and passives bought 1 billion amount. FPI buying continued in August and was to the tune of 1.01 billion till 19th of August. In terms of sectors, they raised their overweight in financials by 22 bips, in industrials by 29 bips, and in real estate by 10 bips. FPI raised their underweight in IT by a large 48 bips, and their underweight in autos also rose by 7 bips. On the domestic side, most of the equity schemes continued to saw Inflows, though a month-on-month moderation in July, other than multi-cap, which saw stronger inflow at 1600 crores versus 700 crores last period, and sectoral funds, which saw inflows of 1400 crores versus 500 crores, helped by newer fund launches. Balance funds also saw a month-on-month rise in inflows. Now, domestic equity ETFs saw outflows of 290 crores versus inflows of 2,800 crores in July. Value and contra funds, small caps, and dividend yield funds saw smaller MOM flows. Insurance, which sold 2.1 billion over May to July, has bought 0.7 billion in August, till August 19th. Overall, we believe that while domestic flows should continue, FPI flows should be expected to taper off given the increased US yield. So this is the one impact of higher US yields. We believe higher US yields make EM equities relatively less attractive. Of course, effect of moves within the EM basket are difficult to forecast. We saw that money moved out of Taiwan to other emerging markets. Lastly, on valuations and outlook, we do expect a period of consolidation to continue. With increase in bond yield, we do expect the growth style of investing to face some headwinds. Index target is just about 5% away, and we continue to expect a period of consolidation. With corporate commentary being strong and with a strong result season, we don't expect any sharp correction. Positive government policy momentum definitely helps. Overall, a quarter of time correction would result in valuation correction by 4% and should suffice to make equities competitive. We continue to believe it is time for alpha, and earnings growth being higher outside that of the index, and with higher growth spaces continuing to deliver strong performance is the reason for our belief that alpha period could continue in the future. Thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.